Hello, everybody. Welcome in to today's live stream. Super excited to be having a discussion about the stock market, of course, and some individual areas, but really a big focus on passive income done for you. We have on today the team from Peerless with an amazing product, WEEL, WEEL, which you can look up on any brokerage of your choice. And we're going to talk about how this product works and where it may fit into your portfolio and really who this is built for. We've done work with WEEL for several months now at this point. It's gotten to know Rob and Eric leading the charge. And so it's always great when we can bring the direct leadership of the team right here onto the live stream so that we can have that conversation with them, because where else is it better to hear from? So with that being said, would love to give each of you opportunity for a quick introduction, and then we'll roll into the discussion. Eric, I'll turn it over to you here.
Hi, thanks for having me. Eric Thompson. I'm founder of Peerless Wealth and co-founder with Rob of Peerless ETFs. And I'm calling from Columbus, Ohio, where we're in a blizzard right now. So I'm glad I can work from home.
Very cool. Very cool. Sadly, no blizzarding down here in Puerto Rico. Maybe one of these days.
Yeah.
Rob, how about you?
Yeah, Rob Pasquarella, co-portfolio manager with Eric for WEEL. I also work in his RIA. Been working with him almost 4 years now. So
very cool. Very cool. Appreciate the quick introductions and the areas. So Eric, I'll turn to you to kick things off here first. I just want to start with, why did you create this?
I'll start that with a couple of stories, or I'll answer that with a couple of stories that I still remember to this day. I'm in my late 40s now, and when I got my finance degree from Miami of Ohio, about a year after I had got my Series 7 license, which allowed me to advise clients and sell securities and sort of get started in this business, and that was 1999. And the year 2000, the year 2001, and the year 2002 were all three negative years for the S&P 500. And add them all up, it was down almost 40% cumulative over those 3 years. And 1999 there was a tech craze back then too. It just ended with .com instead of AI. And they're different, but there was, some elements that were similar. And I remember specifically, I was probably mid-20s at the time, and I had someone that was referred to me for retirement planning, and they had retired from AT&T. They were a union. They worked up on the telephone poles, middle income type, worked their whole life, started at age, 25, got their 30 years in. At age 55, the guy decided to retire based on the advice of another advisor. And they could take their pensions lump sum. He had their 401k. I can't remember exactly what it was. Let's say it was $600,000. And this was in 2000, and he came to me 3 years later. His advisor told him he could take 9% portfolio withdrawals because the market was producing 13 and 14% a year, and he'd be fine. And this is a professional telling people this. And it's interesting because, and I love Dave Ramsey, like 90% of his material. I think, it's good. But I heard a quote from him saying something similar recently. And his portfolio got cut in half. The guy's 55, 600 grand times 9% is 54,000 a year. That's all he needed. That was basically replacing his middle income back 20 years ago. And now his 600 grand was 300 grand. And he was wondering what happened. And that, when I entered into the business, and that's not the only version of that story, there were many, those really shaped the way that I allocate investments for clients and the way I plan for retirement. When I have a client that's retiring, I don't want them spending principal. I only want them spending income. And if you can and it sounds super simple, but even advisors, they'll fall into this trap is, okay, you're a 60-40 portfolio, and you can take 5% a year, and you're not getting 5% in income. on that type of portfolio. You're spending principal and you're hoping that the returns, and they usually do, but not always. And that period of time from 2000, some of the listeners here may have heard the term lost decade. And what a lost decade is defined at in my world is a period of time, and they look at the S&P 500 because that's the broad index that's referenced, in which an investor made no money. It was essentially, and it's rare, there's only a few of them, but that was one of them from 2000 to 2010. And we're going to tell you about some ways to survive if there's another one. Now, maybe not just survive, but actually do okay during a lost decade. And so I always dealt with a lot of retirees, and I was always looking for ways to solve the problem of create income, but also give some growth, right? We don't put everything in bonds or everything in high yield notes and not have any principal growth because there's inflation out there too. And so it's always about striking that balance. And traditional products, that pay, stock funds that pay dividends, they're great, but you might make 3 or 4%, right? You're not gonna make a ton of money at retirement by just 3 or 4% yield. Bond rate yields are higher in bonds, but treasuries are still in the 4s. And people now know after 2022 that bonds aren't guaranteed. They can and will drop significantly in principal if rates go up, and inflation's looking sticky. The Fed's looking like they might not cut. Rates are staying stubbornly high. That seems like it would be good for bonds, but it's actually put pressure on the principal of bonds. So the bond market's not always the answer. Stock market may not produce enough income. You need those, but you also need to be thinking outside the box. And that's really the genesis of this product. Is we are using the options market to sell put and call options to speculative buyers that are betting on big gains or big drops, and we're harvesting income, and we're using that income. If a client's retired, it's great. It lets them not sell principal. If we're at the beginning of a lost decade, then it could be the best thing in your portfolio because, I think we're yielding 14% on the ETF. But this is an income solution. This is not a, what is hot now and what's going to make the most money in the next 3 to 6 months solution. It's not that. And I know there's other broadcasts for those types of things. This is more of a strategic look at a multi-year potential outcome of a flat market or something close to a flat market, and why you may not want to have all your money in the S&P 500 like a lot of people even in my community say. So that's kind of how it got started.
Do you think even for those that are perhaps not at the stage that the person that you spoke about, right, that they needed to stay consistent? I mean, even people that are maybe 30s, 40s, right, but are starting to allocate portions of their portfolio in that direction, could this also be something for them? And then for people that are in the retiring stage, how do you look at optimal portfolio construction as a manager yourself?
Yeah. So I'll answer the second one first. And I have a lot of these clients because Peerless Wealth's we're a registered investment advisory. We have individual high net worth clients. We have middle of the road clients, and I have a lot of retirees. And what most retirees need, if they're comfortable with a moderate amount of risk, which I think retirees need to be, and they want their money to last 30 years plus, and they want it to keep up with inflation, is they still probably need 50% of their money in equities. Now, if that's 60% or 40%, it's not going to be that big a deal, but it should be somewhere around half in equities. I would prefer the dividend variety. And that's not our product, and that's fine. Our product is a sliver of a portfolio. It's not the whole thing. And there's some great dividend ETFs out there. SCHD is a good one that I use a lot in practice from Schwab. But the best case there, you're making maybe 4% yield. I think it's 3.5. And you need some growth stocks, but they're not going to produce any yield. So maybe only 5 or 10% in like FANG type of names. And then you do need some fixed income, but probably not more than 20 to 25% of your portfolio. And then the way I do it is I use option income. Our fund WEEL is a great solution. There's other ones out there. We have a unique spin on that. No wheel pun.
Yeah, nobody's doing the WEEL strategy.
Well, yeah. So we probably should define what the hell a WEEL is.
Well, so in keeping that in mind, because I think this is a good question. I'm close to retirement. Like, this is probably the question I'd say that people would like to answer. You know what I'm saying? So I don't know if you can kind of, in your explanation, kind of answer this as well.
Yeah, and so you have maybe somewhere close to half favoring the dividend variety. You maybe have somewhere close to a quarter in bonds, and then what we are is what we call alternative income. And I'm
Oh,
Yeah,
Rob?
all right. I'm back.
Oh, there we go.
Okay. A word on passive income, because you hear the term passive income just thrown around.
Yeah.
Passive income is not buying a car wash or a set of vending machines or real estate, rental income. Those are businesses that hopefully create some semi-passive income, but those require you to work, sometimes full time, at those things. So I would not consider those passive income. Plus, they're very difficult to own in small increments in IRA accounts and that sort of thing. So truly passive income are things like dividend stocks, interest on bonds, or products like ours that create regular dividends. We are an income. We're not a growth fund. We're going to stay, in all probability, somewhere around $20 a share, give or take, and we're going to pay a quarterly dividend. Now, the retiree, yeah, there's a place for it. But the younger person, anybody that's worried about a go nowhere, range bound, flat market, lost decade, we're going to show you some evidence on why you might want to consider that possibility. I'm well over 10 years before I'm planning on using the money, but I have, somewhere around 20% of my investable assets in this because I want to hedge against a flat decade.
So I guess just within that question, so obviously there was a big bubble that popped in the beginning of that decade that led to it being, a lost decade. And obviously not lost for those that came in mid that decade, more so for those that, if you look at the decade as a whole, when you look at the last few years, do you believe that the AI explosion is going to have similar repercussions to the 2000 to 2004 area that leads you to believe that people that are getting into something like WEEL are kind of getting a head start?
I think we lost them again.
Would you want to take that one on?
Yeah,
I would
totally.
also add to that if you want to talk about, like, is AI ever going to make its way into what you're doing?
We're back. All right.
No problem. Eric, I'll
Everybody get kicked off or just me?
Just you.
No, just you. I'll repeat that question though. So back in 2000, what led to those 3 consecutive down years that you were mentioning was the burst of that .com bubble. And now we have AI coming into play. I think there's certainly some differences, but as a historian of the market, do you see a lot of similarities that should lead you to believe that we're going to have a similar type decade? And is that why you're saying, hey, I'm getting a head start here with WEEL? And then Austin had an interesting question, which is, do you ever see AI being implemented into those strategies that you're running now?
So there's some similarities. I don't think we're going to get a 75% drop. I'm off again. God.
No, you're on.
Oh, I am. Okay. I don't think we're going to get a 75% drop in the NASDAQ. A lot of those .com names weren't making money, and it's not, they're not as high quality as the names that are out there right now making billions. But I do think valuations are very high. One thing that got people through that lost decade, and I'll say this again, from 2000 to 2002, the S&P was down 40%. In that same period of time, if you had an alternative portfolio that was equally balanced between small cap value stocks, large cap value stocks, and real estate investment trusts, those three areas combined over those same 3 years were up about 5%, not a lot, but way better than being down 40%. I need everyone listening, do not forget about all of the areas of what I call the asset allocation pie. The S&P 500 right now is dominated by a lot of large cap tech stocks that are phenomenal companies, but the valuations are very high. Don't forget about small caps. Small cap value index is 11 times earnings. The S&P 500 is about 24 times earnings. And I just read small caps are growing their earnings at a higher clip than large cap, and they're trading at half the price.
Yeah,
They have been out of favor, and there's reasons, but own small cap, own real estate investment trusts, even though they don't look that great over the last few years. The worst way to invest is look at what did the best last year. Pile all your money into that, and repeat every year.
Yeah.
Okay, that's performance chasing. In fact, there's been studies on this. You're better off doing the opposite, actually.
Yeah.
Where you buy the worst performer, but that's not human nature. People have FOMO, and we need to think rationally, and we need to own those other areas. So, how to survive a lost decade, whether you're 20 or 70, is don't own all S&P 500. Own some small cap. Own some REITs, and own some things that pay income. I would be partial to WEEL, but things that pay income, we don't need markets to go up to create our yield.
Let's talk about that. What is the optimal market for you? Like, where's like your money-making haven where you and Rob are shirtless on the beach, just sipping the Mai Tais and enjoying your life? What does that market look like?
Well, so our fund is not built to do explosive returns like 25, 30% in a year. It can't the way it's
I mean more so when you're counter to the regular market.
Yeah,
you're
so on a relative
10%,
basis,
the general markets are getting shelled.
A flat range bound, slightly up, slightly down. That's where we're going to look really good compared to everybody else. In a strong bull market, we'll do fine, but we're not going to keep up. In a strong bear market or a bad down bear market, we're going to lose, but not as much. So what we're doing is we're solving for that middle ground. And Rob, I don't know if you could pull up that chart on the website, the probability.
Yeah, I have it on the stage here.
Okay, we'll do this one first.
Which one would you like? This one?
That one, yeah. Okay, so this goes back 100 years to 1925, and it shows you the S&P 500 returns, and it's just a 3-bar distribution. So on the far right is a light blue bar. It says 49% frequency, over 15%. So the S&P 500 gained over 15%, 49% of calendar years going back 100 years. And that's why we need to own stocks long. I'm not a bear or advocating against just Buffett style buy and hold, because that's where you have some good years. The last couple have been very good. It happens over half the time you make over 15%. On the flip side, over to the left, in what I would call bear markets, the S&P loses more than 8%, 19% of the time. Now, we're not going to necessarily make money there, but we'll lose less. But the green bar is our wheelhouse. No pun intended again. That the green bar is the S&P 500 return between -8 and +15, 32% of the time. So if you were a baseball coach and the ball got hit to right field 32% of the time over the last 100 years, Do you think you should put a right fielder over there? Maybe two, probably. And so that's where we're built. We're going to be sort of your flat market, your range market solution. Because what we're doing is we're selling puts and calls for extra income. But what that does from a math standpoint is it caps our upside some.
Right, but still massively hedged against down.
Yeah,
which is the key. So again, another question. It sounds like money I can invest in WEEL could be viewed as a side hustle that produces passive income.
Yeah, it's not even a side hustle. A side hustle, I always think about like maybe working, like doing something.
Right, without the effort on our part.
It's not even a hustle. It's just you put it in there. If you don't need the money, reinvest the dividends. Okay, that's very important if you're maybe younger, and because if you just let the dividend sweep and then do something else with it, and you look at WEEL 5 years from now, you're going to think you haven't made any money because it's still going to be around $20 a share. But that's like looking at a rental property and forgetting about the rent. Like we're all income. It's not growing price, but it's going to create, you know, we're yielding between 14 and 15% now. You know, we will move. We are correlated to the S&P 500, but in a muted basis. We don't have an official calculation on our site, but I think our beta is between 0.7 and 0.8. So we're taking about 20-30% less risk than the market. And so, yeah, we're and Rob, let's go to that other chart, because this is, I think, probably my favorite argument for you know, number one, setting expectations for listeners. The last 10 years, if you look at the last 10 years of the S&P 500, it's been like 13% annualized. The long-term average is 9 to 10. I don't know if you guys, everyone on there can see this, but it's kind of busy, but I'm going to focus on the right chart. What this measures is a 10-year, each one of the blue squares represents a 10-year average annual return from starting PE ratios. So most of you heard of PE ratios. The long-term average price earnings multiple of the S&P 500 is about 16. So right in, you know, kind of the middle of that. So if you start at lower than average price earnings multiples, your next 10 years are typically higher than average. That's when you got, gosh, you almost got 20% annualized because you were starting from really cheap markets. In 1999, when I got my Series 7 license, the S&P 500 was about 27 times earnings. In fact, it's the only period of time it was higher than it is today, or one of only. There might have been another one in there, but we're in the top 5% of high valuations on the S&P 500. We're sitting at about 24 right now. And that's that green bar. And other times we've sat at those high valuations, or God forbid, higher, the next 10 years suck. There's your lost decades. You see, they're kind of all around zero, and there's even some negatives in there. Now, the chart on the left is the same thing, but it's the next 12 months. This is not a prediction over the next 12 months. There's too many other things to factor. Valuations like PE is a horrible short-term indicator, as shown by the chart on the left. But it's a pretty darn reliable long-term indicator, as shown by the chart on the right.
So would you say that 10 years is that time frame you'd want to look at it, kind of through that lens?
Yes, that's what the chart on the right does. It's the 10-year future average annual performance of the S&P from a starting PE ratio.
Okay, so just to break that down for everybody, basically what he's saying in a civil context, right? On the left, if you use PE as your year-to-year basis, like I'm looking 2025, how am I going to win? And I'm looking at PE as that kind of driving indicator to make that decision. As you can see by the scatter plot, it's a mess. I'm not going to be very consistent. I'm probably not going to make a lot of money. If you move your attention to the right, that is over 10 years. If I make a decision today based on PE with a 10-year outlook, it will typically outperform, as you can see by the graph.
Yeah. So the lower the starting price earnings multiple, the higher returns your next 10 years are going to be, and vice versa. And that makes logical, intuitive sense. And we are sitting at higher than average, quite a bit higher than average PE multiples.
What escalate? I guess what is the delta behind that multiple? Like, what would it just give us, like, in a broad sense? Like, is it really just that the business has built, whether it's traction and a moat, and they have a narrative? Is that kind of why the PE escalates like that?
Yeah. So a couple of reasons. If the price goes up and the earnings don't, then the multiple expands because you just have a lot of bullishness out there. There's a little bit of that.
Right.
If the price just has to go up faster than the earnings. Now, we do have the Mag 7 in there, most of which, aside from maybe Google, most of which are trading at 30 and 40 times earnings. And they are a significant overweighting. The Mag 7 is like, I don't know, 25% of the index, something like that.
Yeah, it's madness at this point.
Yeah. So in other words, 7 out of 500 stocks represent 25% of the stocks. For the readers that don't know, the S&P 500 is cap weighted. You're not getting an even 500th of every company. You're getting more of the companies that have a higher valuation or higher. Yeah, they're worth more. And those companies, those top 7 companies, are amazing. You're right. They have very wide moats. It's not like the dot-com bubble there. And if you stripped out those companies, your multiple is a little more reasonable. It's probably more like 20 instead of 24, 25. But it's still a little higher than average. And so what I would advocate to a typical investor is just don't have everything in something that moves with the S&P 500. Instead of having, if you normally would just have all your money in that, maybe it should be half, and maybe the other half should be spread between, small caps, REITs, God forbid, emerging markets and international.
Who's that guy from Yale? Who's that guy from Yale that has supposedly
Swanson?
Yeah, with the index balancing strategy.
Yeah, so it's what we call and he uses a lot of alternatives, right? So these giant endowments can hit the minimums associated with private equity and hedge funds and things that you can't buy in your Schwab account, and those aren't for everybody. And I think there is a little bit of those appear less volatile, but I'm not sure if they are. They're just not priced every day.
It's the 60-40, right? He's going stocks and then like bonds, but then he's spreading up each tranche, diversified across different indexes, right? In different industries.
The typical endowment, or even the typical financial advisor advising a retiree, will start with a 60-40, right? 60% stocks,
so that's
40%
base
bonds.
model, if you will.
What a lot of the endowments, Swenson Pie.
Oh, frozen. Rob, quick question while he's frozen. Stocks Wizards asking, can the larger multiple or the companies with the larger multiples, can they effectively push out some of the smaller multiple companies, like in terms of their, share percentage of?
Oh yeah, that's basically what happened. Basically what is happening, right? Because when it's Eric touched on it, it's market cap weighted. So as all these
large cap
massive
stocks, you have to own these other areas, despite the fact that they may not look great over the last 5 years. They're cheaper, and they'll help you be more consistent in reaching your goals because you won't have a lot of big swings, and you can potentially survive a lost decade a lot better. So,
love it. So Rob was just telling us, because we had a question here that honestly I was wondering myself if that's how it worked. The companies with the larger multiples, they effectively push out the smaller players in the indices, which then it does the opposite of what you'd kind of look to an index to do, which is allow for diversified holdings and give you broader exposure. You're actually getting less of that as these large cap, very speculative names grow, right? Like, we're not arguing with NVIDIA's position in the market, but on the same token, it's like the buy was when it was trading at like 10 post split price, right? Like the buy now is like, what are we doing here?
Well, I think people just have to, and that math is perfectly correct. And what people have to understand is they probably are taking more risk in owning an S&P 500 fund than they think they are, because of the overweight to those large cap names. And there are other S&P 500 ETFs that are equal weight. There's a ticker RSP, Ralph, Sam, Paul. I think it's Invesco's equal weight, and it's crazy, the dispersion. I think over the last couple of years, it's only done about 50% of the market weight. But it's lower PE, which means lower risk and better chance of surviving a less decade. The things that pop the hardest, the bubbles that pop the hardest, are almost always the highest PE stuff. Because if the earnings don't come through, they're priced to perfection. So if they stumble hard.
Yeah, you got to grow into them, right? Like what that is saying, when NVIDIA is trading at a 30-40 multiple, that means it's going to take that long to grow into it, right? So it's either got to continue that massive growth, or the ratio's got to come down. But people don't think about it that way, I don't think.
Yeah.
Well, imagine owning I was talking to one of my clients that owns a plumbing company, and pretty successful, local here in Columbus. I think he has like 20 employees, and I think he was doing like $4 million a year gross. And I'm like, okay, so what are you netting out of that? And after everybody gets paid, you pay yourself a reasonable salary. And I think, let's say he said 400 grand. Okay. I said, well, multiply 400 grand times 45, because NVIDIA is trading at 45 times earnings. That's $18 million. Would someone pay you $18 million to take over an earnings stream of 400,000? No way. Now, they're not NVIDIA. I get it. But that helps put it in perspective. Take your own business and do that earnings multiplier. Rob and I were just talking about Planeteer is even crazier.
Yeah.
And we're not talking about companies that don't make money. Right.
You're talking about, I mean, the most popular names in the market that, because of the hype, people kind of miss the opportunity. And then, they're the exit liquidity, and we don't want to see that happen with anyone. So before we wrap up here, I think this is probably the best question we've got all night is, who is the ideal investor for WEEL?
I'm going to keep it simple. Two people: retirees that want to draw interest and dividends only to have a sustainable retirement income that's reasonably high, right? That's not 3%. That's number one. Number two, anyone that's concerned about slowing returns, a lost decade. It's not half your portfolio. It's 10%, maybe 20. And it's not about knowing where the ball's going to go. I'll get back to my baseball analogy. It's just having someone in the field just in case it gets hit to that area. Even if the ball hasn't been hit to right field for a while, we might want to have somebody over there. Those two. I mean, like I said, I might have got cut out, but I own it. I'm well over 10 years away from needing the money. I reinvest my dividend. I have about 20% of my own liquid investments in it. The rest I have in those other areas I talked about, including things, the S&P 500 that are apparently overvalued. There's
a comment in the chat too. If you're younger than a retiree like we all are, it's a great product for Roth kind of vehicle.
Yeah, I had that up on the screen. That's what Mitch Data Sniper was talking about.
Yeah, so
I would agree.
Yeah, it is if you have an IRA, whether it's a regular IRA or a Roth IRA versus just a taxable brokerage account, err on the side of putting it in your IRAs, because the income, if held in a taxable brokerage account, will be subject to taxes just like interest income is on your savings account. So you're better off owning it in in an IRA account? Good question.
I gotta say, I'm gonna give a shout out here. Tony B, this is my guy. So he's one of our students that we teach the WEEL strategy to, and has crushed it this year. A, but B, I love that this is a smart man here. See, he does do it actively, small scale. What does he do in the Roth? He's got WEEL in there.
Well, and we haven't talked about the mechanics, and we're not going to, but our website has a lot of really good info on it. And we run the WEEL, I would say, pretty conservatively. We don't use individual stocks. We write out of the money puts, so you get kind of a buffer on the first chunk of losses. I'll give you one statistic, and it's only 2 weeks, and I'm preaching the long term, but I got a year to date, the S&P 500 is down 0.5%, and we're up about 70 basis points. So that's kind of the environment. It's super short term, but you know, when the market's
security. I mean, I don't think you're talking enough about that. It's like, look, me and Shai were just talking about this earlier, right? I don't manage all of my money. I could, but I can't emotionally, couldn't deal with it.
Yeah.
Just couldn't. So my brother-in-law manages a big chunk of it, and then I actively manage my piece of it, right? Kind of just to prove I want to be a man and prove, you know, it is what it is.
Yeah.
I also enjoy it. But
engaged.
Truth be told, the money that's going to impact my children when I'm gone, and my wife, if something would happen to me, he's got, and it's very similar allocation to what you described, right? He's got it well balanced. We're producing some income. We're reinvesting it. We've got some growth exposure. I do have a little more small cap value than maybe would be suggested, but also I can take a little bit more risk at my age right now, 34. So it's worth it. And I think small cap value's taking a beating it didn't deserve.
It'll come back.
Right. But the whole idea is the peace of mind, guys, that I have effectively purchased, right, by paying the fees for someone to manage it and do it for me, is absolutely well worth it in my position, because I know that if things were to exist outside of the scope of my control, another COVID or something insane, right, or even a nothing burger, and I think everyone should be very prepared for this year to potentially be a big old volatile nothing burger. It'll up and down, but at the end of the year, we'll end up right back where we started, because the run already happened, right? So, like, what do I want in that time? I want to know that I have the peace of mind that on the downside, I'm covered to a degree. It's never 100%, but covered, right? And then on the upside, am I willing to give a couple points here and there, whereas guy down the street took all the risk, all the stress, got 10 basis points more than me, versus I had no stress, no muss, no fuss. I got the upside, I got the risk protection, but I got the peace of mind to live my life. And I think that, to me, is what you guys do, like in it from an emotional standpoint for the end user. A lot of our lifetime members buy your product because they love the WEEL already. I mean, we teach it, but we had a few guys in there, six figures or so in the WEEL. So shout out Tony B. I'm just saying,
Thank you.
I love it, but like they get it, and they're following the allocations that you're obviously indicating. But I think what they've told me and what we agreed upon was, like, it's really cool to see an inventive strategy that we already implement, right? Because we know is smarter than most of the market. There's a reason you make money selling premium, but also giving you the opportunity to buy good names at a discount when you do get the downside. So
yeah. I don't
beat
think we said it, but we are the only mutual fund or ETF that uses the WEEL as our primary
existence
strategy. It's and we actually filed for a patent on it.
Boom.
Still pending.
I love that. Build that moat. You guys heard it. So peerlessetfs.com, guys. It's the WEEL, ticker WEEL. These guys are the real deal. You could just tell. I mean, look, they care about it. You don't get that much, guys. We interview people that run funds. We issue issuers. I love you guys because you give a shit. That matters to us, because at the end of the day, this is people's hard-earned living. You know, it's their future. And I'll tell you this, guys, personally, that you know, if there's anybody that I've met that you could trust, it's the guys running this for you. So take a look. Obviously, make your own decision. Talk to your advisor. Do what you got to do. You guys heard the allocations. Nobody's saying go all in WEEL. They're saying, hey, it's a reasonable percentage that provides that passive income. It's important. It's an element of an overarching strategy. I'm glad you came. Look at that. Boom. Mitch, thanks for showing up, buddy. I appreciate you. Hopefully we'll be having one of these again in the future one day. Almost 4,000 listeners. Shout out. We crushed it.
I appreciate everybody.
So I love you guys. Again, click the link in the bio. Click the link in the post to read more. I also posted it in the chat. You could also just alternatively go to your brokerage, type in WEEL, add it to the watch list so you can go back and read a little more about it. I found some great literature on TD Ameritrade has some good kind of insight on you guys. I know my money that's in Oppenheimer. They have a little report on you. So just guys, do your research, talk to your advisor, talk about WEEL, talk about passive income, make sure you're well allocated. Thank you guys for joining us. We appreciate you. And again, I hope we can reconvene soon. It's WEEL, guys.
Thanks, everyone.
Thank you, sir.